Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Rigetti Computing.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here's a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saved screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list and comes down to about $14.93 per month when billed annually after the discount. Stockanalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
So imagine waking up, checking the market, and seeing a stock in your watch list has surged more than 50% in a single month.
Yeah, that is definitely not a typo. We are looking at a massive, violent breakout here.
Right. And the trigger. A $100 million government grant that basically just dropped out of the sky.
Which is genuinely a staggering amount of capital for a company of this size.
Oh, for sure.
I mean, the government does not simply write a 9-figure check without an immense amount of strategic vetting. They're picking a horse in a very complex race.
I hear that, but my skeptical alarm bells are ringing at maximum volume right now.
Yeah.
We really have to be honest about what this company actually does today.
Fair enough.
This is a pre-commercial, pure-play quantum computing firm. Their annual revenue is nominal. I mean, sitting under $20 million.
Right.
And they're torching cash to build hardware that requires temperatures colder than deep space just to function.
Yeah, it's extreme physics.
Exactly. So the ultimate tension for you, sitting there managing your own portfolio, is figuring out, is this $100 million just a temporary oxygen tank for a company drowning in research costs? Or is it like the ignition switch for absolute commercial dominance?
Well, to answer that, you really have to zoom out and look at the structural pressures of the entire tech sector right now. The limitations of current hardware are forcing this issue to a boiling point.
All right, let's move into the wealth building context.
So if you are looking to build generational wealth, you're generally hunting for structural megatrends, right?
It's like the game changer.
Exactly. Technologies that will fundamentally rewrite how the economy operates over the next, say, 10 to 20 years. Quantum computing is that next frontier. Think about the massive AI hardware boom we're living through right now.
Oh, it's everywhere.
It is. But classical silicon chips, the kind in your laptop and the massive data centers running AI, they are hitting a physical wall. You can only shrink transistors so much before you run into the literal laws of physics.
So to solve the next tier of mathematically impossible problems,
yes,
like simulating new life-saving drugs at a molecular level, or, optimizing global supply chains in real time, classical computers just won't cut it. They would take thousands of years.
Precisely. The world absolutely needs quantum infrastructure to make that leap. And for an investor, a company like Rigetti represents this high beta, pure play exposure to an industry that is, frankly, barely out of the laboratory phase.
And pure play simply means they aren't distracted by selling traditional software or cloud storage.
Right. Their entire existence is tethered to making quantum work.
But that means you have to severely manage your expectations. I see a lot of people treating this like they're buying a high-flying software as a service stock.
Oh, definitely not.
No, it's not. A much better way to frame this is to imagine you are trying to invest in the creation of the electrical grid before the light bulb was fully commercialized.
Yeah.
You are laying tracks for a train that is still being designed.
Yeah, that's a great analogy.
You aren't buying this for a quarterly dividend check, and you certainly aren't looking for share buybacks anytime soon.
Exactly. You are adopting a multi-year time horizon. The goal here is to hold your position patiently so you can capture the exponential upside of the commercialization curve.
The fault-tolerant curve, right?
Yeah, the industry is chasing something called fault-tolerant quantum computing. Right now, quantum processors are incredibly prone to errors because the quantum states are just so fragile.
because even the slightest vibration or temperature change ruins the calculation.
You got it. The company that figures out how to make these systems stable or fault tolerant wins the era.
Which is a beautiful vision for the future, but, surviving long enough to see the future requires cold, hard cash today. Now let's look at the fundamentals.
Right, because if the financial engine stalls, the groundbreaking physics won't matter at all.
True.
Since we are dealing with a pre-commercial business, we have to look incredibly closely at their survival metrics.
I'll be blunt here. The initial look at the balance sheet is painful. As we noted, revenue is nominal. The money trickling in mostly comes from government research contracts and their quantum cloud services.
Yeah, that's a system where they basically allow researchers to rent time on their quantum machines over the internet.
Right, but their free cash flow and net margins are deeply negative.
And we have to explain why that burn rate is so aggressive.
Yeah.
They're not just writing code in a leased office building somewhere. They are physically constructing and operating their own chip fabrication facility known as Fab 1.
Which is massively expensive.
Unbelievably expensive. On top of that, they're aggressively developing their 84-qubit Anka system. Building a fab is historically one of the most punishingly expensive undertakings in the tech sector.
Oh, absolutely.
You are dealing with ultra-high vacuum chambers, specialized lithography, and cooling systems that push the absolute limits of modern thermodynamics.
Which brings me to my biggest historical red flag with this stock. How do they pay for all those expensive toys? Exactly. Historically, they relied heavily on at-the-market offerings, or ATMs. For anyone unfamiliar, an ATM offering is when a company creates new shares out of thin air and sells them directly onto the open market to raise cash.
It acts as a hidden tax on the current shareholders.
It totally dilutes you. Imagine you own a slice of a pizza, and suddenly this chef just shoves more dough into the center of the pie. Your slice just became a smaller percentage of the whole.
Yeah, nobody wants that.
Right. In a macroeconomic environment with high interest rates, where borrowing money from a bank is incredibly expensive, companies lean on diluting their shareholders. So my question has always been, how can they possibly survive this cash burn before dilution crushes the stock price into pennies?
That is the pivotal question, and it is exactly why the $100 million government grant completely rewrites their investment thesis.
It changes everything.
It really does. That $100 million is non-dilutive capital. They didn't have to sell pieces of the company to get it. It subsidizes their massive research and development overhead and violently extends their cash runway.
So it basically removes the immediate threat of them having to dilute shareholders just to keep the lights on in the fab facility.
Exactly. It builds a financial fortress around them for the medium term. And it's crucial to understand why they were chosen for that grant over, say, a dozen other startups.
Right. Why them?
It comes down to their proprietary approach.
Yeah.
A modular superconducting qubit architecture.
Okay, let's break that down, because modular superconducting qubit sounds like alphabet soup. Explain the modular part. Why is that a competitive moat?
So to understand the genius of it, you have to look at the flaw in the traditional approach. Many competitors try to build one giant, perfect quantum processor.
Okay.
But as we discussed, qubits are hypersensitive. The larger the chip, the harder it is to keep all those qubits stable, and the error rates just skyrockets, like trying to perfectly balance 100 spinning plates at once.
And eventually one drops and ruins the whole thing.
Exactly. So Rigetti's modular approach changes the game. Instead of one giant chip, they build smaller, highly stable chips and then physically link them together using custom technology.
Oh, wow.
Yeah, they are basically building quantum processors out of incredibly complex Lego blocks.
That makes profound mechanical sense. If one small block fails quality control, you just throw it out. You don't lose an entire massive processor.
Exactly.
And because they own Fab 1, they manufacture these specific Lego blocks entirely in-house.
That vertical integration is their shield. They have total design control. I mean, they can tweak a design and test it the next week, whereas a competitor might have to wait 6 months for a third-party manufacturer overseas to build a prototype.
Speed is huge.
It is. Plus, once an enterprise integrates their complex data into Rigetti's specific cloud architecture, the switching costs to move to another provider are massive. It locks the customer in.
That brings us to the catalyst timeline.
We know the balance sheet is suddenly fortified by the government's cash. So what are the tangible events that will actually move the share price over the next few months?
Well, the first major checkpoint is the upcoming Q2 2025 earnings report. But I want to caution everyone listening. If you open that report looking for traditional earnings per share, you are doing it Wrong.
Yeah.
Wall Street does not care about EPS for a company in this phase.
No, they care about execution. Analysts will be combing through the statements looking for the exact timeline for deploying that $100 million.
Right. Has the cash burn stabilized? Are they utilizing the grant effectively?
Exactly. But more importantly, the market is looking for operational milestones regarding their Anka 2 system. Investors need proof that the error rates are dropping and the processing power is actually scaling up.
And then there are the industry events, right?
Yeah. Furthermore, the broader tech calendar matters. Industry events like the Q2 Quantum Computing Summit serve as launchpads for sudden, stock-moving announcements.
So those are the scheduled catalysts. Let's talk about the speculative ones, because that is where the explosive volatility lives. When the United States government hands you $100 million, it sends a blinding flare up into the sky.
It really does.
It signals to every other defense agency that your technology is legitimate. So naturally, the market is buzzing about potential future defense contracts, specifically tied to DARPA's quantum benchmarking initiative.
Then there is the ever-present chatter surrounding mergers and acquisitions.
Oh, definitely.
Put yourself in the shoes of a legacy tech giant, a massive cloud provider with hundreds of billions in cash. They are watching the quantum race terrify classical computing executives.
Because they don't want to be left behind.
Exactly. If one of these giants feels they are falling behind, building their own quantum fabrication plant from scratch would take a decade. It is infinitely faster to just buy a company like Rigetti, absorb their Fab 1 facility, and instantly own a modular quantum architecture.
We also have to acknowledge the macroeconomic tailwinds here. This stock is highly sensitive to the Federal Reserve. Any chatter about cutting interest rates acts as rocket fuel for pre-profit, high-growth companies.
Cheaper money means a higher tolerance for risk across Wall Street.
Exactly. And let's not forget the spillover effect. Hyperscalers are currently dumping hundreds of billions into AI data centers. Eventually, they will realize they need quantum processors to push AI to the next level of reasoning. That capital will naturally flood into pure-play quantum firms.
Now let's pivot to the chart.
We know the story and the catalysts, but how is the market digesting all of this? Like, what are the actual price dynamics telling us?
The technical setup here is intensely bullish. That 50% monthly surge was not just a random spike. It was a definitive breakout from a grueling long-term basing period.
It broke out of the basement.
Yeah, the stock spent months consolidating, building a floor, and then basically shattered its resistance levels to establish a clear sequence of higher highs.
I do want to address the recent price action, though. Following that massive run, we saw a 4% gap down, putting the stock right around the $24 level. I know it's really easy to panic when a stock you're watching suddenly prints a red candle after a historic run.
Right, but you have to contextualize it mechanically. A straight line up is actually more dangerous because it creates an unsustainable bubble.
Exactly my thought. This 4% pullback shouldn't be viewed as a breakdown in the company's thesis. It was a textbook, healthy rotation. We saw sector-wide profit-taking alongside their peers, like IonQ.
Right, algorithms taking profit.
Yeah, when institutional traders are up 50% in 30 days, algorithmic systems automatically trigger sell orders to lock in gains. What matters is the reaction to the drop. That $24 mark isn't just a random number. It's acting as a psychological fortress.
Oh, people are buying the dip.
Exactly. The technical data shows dip buyers eagerly stepping in at $24, treating previous resistance as a new, hardened support floor.
So what does market sentiment look like?
Well, given the breakout and the volatility, the mood on Wall Street is wildly bifurcated. You have absolute zealots on one side and entrenched skeptics on the other.
Yeah, on the bullish side, the qualitative data points to a fever pitch of retail and algorithmic excitement. If you scan the institutional analyst desks and the retail forums, the narrative is entirely anchored on the idea of Uncle Sam buying in.
Right.
The prevailing question is whether this momentum will carry the stock to a $50 price target.
Which, to be clear, implies more than 100% upside from where it currently sits at $24.
It's massive.
The market is viewing that grant as sovereign flow validation. It essentially communicates to every hedge fund manager, the foundational technology here is not science fiction. It is a critical national interest.
However, you promised skeptical counterbalance earlier, and we really need to look at the bearish pressure suppressing that $50 target.
Yes, we do.
Short-term sentiment is fighting a very specific narrative. The idea that the quantum trade is maturing, And as it matures, conservative capital is fleeing the volatile pure plays and concentrating into the safety of legacy blue-chip technology companies.
Now let's talk about the risks.
That flight to safety brings us face to face with the existential threats challenging Rigetti's survival.
Let's lay out risk number one, the Goliath in the room. And that Goliath is IBM. IBM is not just dabbling in quantum, they have publicly committed a staggering $10 billion investment into their quantum computing roadmap with a major commercial milestone targeted for 2029.
It's a huge bet.
It's massive. Let's be brutally realistic for a moment. How does a company with less than $20 million in revenue avoid being entirely squashed? When a Fortune 500 company wants to buy quantum cloud services, why wouldn't they just go with IBM, who already provides all their enterprise software and has a $10 billion war chest?
The scale disparity is intimidating, I'll give you that. But you have to look at the underlying technology IBM is championing. IBM's massive investment actually serves as the ultimate validation for Rigetti.
Wait, really? How so?
Because IBM is also betting on superconducting hardware architectures. They are validating the exact scientific pathway Rigetti chose. If IBM proves superconducting qubits are the definitive future of the industry, Rigetti's proprietary in-house modular version becomes infinitely more valuable.
Wow, okay.
Furthermore, the total addressable market for quantum solutions, logistics, pharmaceuticals, cryptography, is projected to be in the trillions. It is simply too vast to be a winner-take-all monopoly. Rigetti can thrive by targeting specialized tiers of the cloud market that IBM's rigid enterprise structure might overlook.
I see the logic in the rising tide lifts all boats argument. But risk number two isn't about Goliath. It's about a nimble competitor changing the rules of the game. Let's talk about D-Wave. Up until now, D-Wave has been the leader in something called annealing quantum computers.
Right, we should define that for clarity.
Okay, think of an annealing quantum computer, like a very specialized geographical tool. If you drop a marble into a bumpy bowl, it naturally rolls to the lowest point.
Right.
Annealing uses quantum physics to instantly find the lowest point, or the most optimal solution, for specific logistical problems, like routing thousands of delivery trucks. It's powerful, but it's not a universal computer. You can't program it to run any algorithm.
And gate model is the universal one.
Exactly. Gate model quantum computing, which is what Rigetti builds, is the holy grail. It's universal and programmable.
Which brings us to the threat. D-Wave just published a roadmap announcing they are pivoting aggressively. They are attempting to build gate model systems, directly invading Rigetti's core territory.
It's a terrifying headline if you are holding Rigetti stock. I mean, a recognized quantum brand is coming for your market share.
It's a flashy headline, certainly, but you have to separate corporate press releases from engineering reality. D-Wave is effectively starting from ground zero in the gate model arena.
Because the physics are different.
Completely different. The error correction, the hardware required, it is a fundamentally different discipline than annealing. This is where Rigetti's deep operational history becomes a weapon. Rigetti already possesses a functioning, vertically integrated fabrication facility.
Fab 1.
Yes, they have years of incredibly dense, real-world deployment data from their cloud services. You cannot simply fast-track that kind of institutional knowledge. D-Wave's pivot acknowledges that gate model is the future, but catching up to Rigetti's physical infrastructure will take them years, if they can manage it at all.
So with everything on the table, what's the final verdict?
Well, we have evaluated the intense cash burn realities, weighed them against the transformative $100 million government lifeline, and factored in the undeniable technical breakout on the charts. Synthesizing all of those metrics, the analysis generates a bullish score of 7 out of 10.
A 7 out of 10 is a commanding vote of confidence, but it respects the inherent volatility of a pre-commercial market.
It absolutely requires a specific mindset. The multi-year investment view is clear here. Rigetti offers high beta, concentrated exposure to a technological megatrend.
And you can't ignore the government backing.
No, the infusion of government capital cannot be brushed aside. It acts as a financial shock absorber, profoundly de-risking their balance sheet and giving them the actual physical runway to complete their Anka hardware milestones.
Which means the recent pullback to that $24 support floor isn't a red flag, but rather a mathematically attractive entry point for the patient investor. If they execute on these upcoming deliverables, we are looking at a powerful multi-year hold, positioning the stock for a march toward that $50 re-rating target.
If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
Think about the leap from the earliest room-sized vacuum tube calculators to the seamless smartphones in our pockets today.
It entirely reshaped human history.
It did. Quantum computing is at that exact same starting line right now. The technology is inevitable.
The only remaining question is, do you have the patience to hold the ticket while the tracks are being laid? Stockanalysis.com, Pro Unlimited.
Stockanalysis.com, pro.reftp. Use code ITP for 10% off.
About $5.93 after discount when billed annually.
About $14.93 after discount when billed annually.
We may earn a commission if you sign up through our link.